It's time to expose exactly what's wrong with Bitcoin and crypto, because if you're still making decisions based on a 4-year countdown, the mistake won't show up today, it'll show up 2 years from now when the price doesn't do what you were promised, and you're stuck asking what changed. You didn't miss the cycle. The cycle changed, and most people haven't noticed yet. You clicked this because something already feels off. Bitcoin hit new highs, ETFs launched, institutions piled in, and yet the move felt slower, heavier, almost restrained. That's not a coincidence. And if you keep waiting for the familiar explosion that used to come right on schedule, you're setting yourself up for frustration instead of clarity. Here's the uncomfortable part. Bitcoin didn't break. Crypto didn't fail. The story you were told stopped working, and the longer you cling to it, the harder this market becomes to navigate. Let me put you inside the exact moment this matters. Imagine you're holding through a full year of chop. You keep hearing, just wait for the next phase. You watch leverage build, narratives stack, targets get louder, then nothing happens. Not because adoption vanished, not because Bitcoin lost relevance, but because the engine driving price is no longer the one you think it is. That's the gap we're going to close. Most crypto narratives are built to feel comforting. They give you dates, cycles, and clean expectations. They tell you when patience will be rewarded. The problem is, markets don't care how clean the story is. They care about incentives, liquidity, and behavior, and those have shifted in ways most people are still ignoring. The 4-year cycle used to work because supply mattered. New issuance mattered. When block rewards were large, cutting them in half was a shock. It forced miners to adjust. It squeezed supply at the margin. That created a rhythm, but that rhythm depended on Bitcoin being young, thin, reactive. Now zoom out for a second. Most Bitcoin that will ever exist already exists. New issuance is a rounding error compared to the coins sitting in long-term wallets. That changes everything. When supply growth is low, halving it doesn't move markets the same way. Price doesn't hinge on miners anymore. It hinges on people. That's where the real tension starts. Because people don't behave like issuance schedules. People sell when life changes, when wealth gets large enough to matter, when concentration feels risky, when price gives them an excuse to rebalance. Think about who owns Bitcoin now. Not just new buyers chasing momentum, but people who bought 5, 10, even 15 years ago. Some of them built families. Some of them built businesses. Some of them reached a level of wealth where holding 90% in one asset stops making sense. When price rises, those coins don't disappear. They come back into the market. This is the part most cycle models never accounted for. Distribution, not panic selling, not capitulation. Calm, rational selling into strength. That selling doesn't crash price. It absorbs demand. It slows momentum. It turns explosions into grinds. So when you ask why Bitcoin feels different this time, that's your answer. It's older, it's heavier, and it's owned by people making real financial decisions, not just speculative bets. Now layer the macro environment on top of that. This is where most crypto narratives get dangerously shallow. They talk about money printing like it's a single event, like one day the switch flips and everything goes up together. That's not how this works anymore. We're in a world of persistent deficits. Governments aren't choosing between discipline and stimulus. They're managing structural obligations that don't shrink easily. Debt piles up. Demographics shift. Political incentives lock in spending. The result isn't dramatic tightening followed by dramatic easing. It's maintenance. Quiet liquidity, just enough to keep the system running. That kind of environment doesn't reward everything equally. It doesn't guarantee that every asset rises just because money exists. Valuations still matter. Crowded trades still unwind. Capital rotates slowly, instead of flooding in all at once. This is why you can have record adoption and stalled price at the same time. Why ETFs can launch and the market still feels sluggish. Liquidity isn't disappearing, it's moving carefully. And Bitcoin is now competing inside that system, not floating above it. Here's where the narrative really breaks. For years, crypto taught people that patience meant waiting for the next phase of the cycle, that if you held long enough, time itself would do the work. But time is no longer the primary driver. Liquidity is, behavior is, policy constraints are. That doesn't make Bitcoin weaker, it actually makes it more honest, and that distinction matters more than most people realize. When Bitcoin was young, it behaved like a science experiment. Thin liquidity, extreme reflexivity, small flows could create massive moves. Narratives felt predictive because the system was simple enough to react exactly how people expected. Now it behaves more like a global asset, heavier, slower to move, plugged into real capital flows, real portfolios, real constraints. That shift strips away a lot of the fantasy, and that's uncomfortable if you built your expectations during the early years. But honesty is not a flaw, it's maturity showing up. And this is exactly where a lot of investors get lost. They keep asking why price didn't hit a specific number by a specific date. They replay targets in their head like broken promises. They say things like, "It was supposed to be here by now," as if the market missed an appointment. Those numbers were never promises. They were projections. And more importantly, they were projections built on a framework that no longer fits the market Bitcoin operates in today. When the environment changes, models don't slowly decay. They break quietly and then all at once. If you felt that frustration, the sense that something is off but you can't quite name it, that doesn't mean you're behind. It means you're early to noticing the shift. Most people stay confused long after the explanation is available because they don't want to let go of the old story. Now, let's talk about something even more uncomfortable, because this is where narratives really start to crumble. Crypto loves clean enemies: banks, governments, central planners. It feels good to frame the world that way. It gives you a villain and a hero. It gives you moral clarity and emotional fuel. But the real world isn't a movie. Systems don't disappear just because a better alternative exists. They coexist. They overlap. They compete. And most importantly, they apply pressure to each other over time. Fiat systems don't roll over just because Bitcoin exists. They don't panic and surrender. They respond the only way large systems ever respond. They tax, they regulate, they add friction, they shape incentives, they slow exits and reward compliance. None of that kills Bitcoin, but all of it tests Bitcoin repeatedly in ways that don't show up on price charts right away. That's the part people underestimate. Bitcoin surviving isn't about one bull run or one adoption wave. It's about decades of pressure, legal challenges that drag on quietly, technical debates that resurface over and over, behavioral shifts as different types of holders enter and exit the network. Each one of those matters more than a single price candle, because price can move without resilience. But resilience can't exist without being tested. That's why the obsession with timing misses the point. Bitcoin's biggest test isn't whether it goes up fast, it's whether it keeps functioning while the world around it bends, distorts, and applies stress from every angle. And this is where a lot of crypto investors get tripped up emotionally. A slower market feels like failure. A grind feels like stagnation. Sideways price feels like betrayal. But maturation often looks boring when you compare it to early chaos. Early Bitcoin rewarded speed. If you moved fast, you won. If you took risk, you were compensated almost immediately. Later, Bitcoin rewards understanding. It rewards patience that isn't tied to a countdown. It rewards people who can tolerate ambiguity without forcing conclusions. Now pause for a second and check yourself honestly. Ask whether your strategy depends on a calendar or on conditions. Because calendars don't move markets anymore. Conditions do. Liquidity cycles don't care about halving anniversaries. They don't care what year we're in. They care about deficits, yields, stress points, and political limits. When something breaks, liquidity shows up. When nothing breaks, markets drift, chop, and frustrate anyone looking for a signal. That's why this environment feels harder. You don't get the clean dopamine hits. You don't get the obvious "now it's time" moments. Instead, you get long stretches where conviction matters more than excitement and where boredom becomes part of the test. This is also why overvaluation hurts more now. In a sudden liquidity surge, almost everything goes up together, and bad pricing gets masked. In a gradual environment, bad pricing gets exposed. Crowded trades unwind quietly. They don't explode, they bleed. And narratives that rely on guaranteed upside fade slowly instead of breaking all at once. If you've been wondering why certain crypto sectors ran far ahead of fundamentals and then bled for months without a dramatic crash, that's your answer. Scarcity alone isn't enough. Price matters. Crowding matters. Timing relative to liquidity matters. Bitcoin still benefits from this environment long term, but not automatically, not on a schedule, and not without a kind of patience that feels very different from what crypto taught people in the past. Here's a question most people avoid because it's uncomfortable. What if the real mistake isn't being early or late, but being rigid? What if clinging to a familiar model is actually riskier than adapting to an uncomfortable one? Markets punish certainty more than they punish doubt, especially when that certainty is built on assumptions that no longer hold. Doubt keeps you flexible. Certainty locks you in place while conditions change around you. This is where discovery actually begins. Not when you predict the next run, but when you stop asking when it happens and start asking what conditions would make it sustainable. Look at how capital behaves now. Institutions don't chase blindly. They don't YOLO into narratives. They size positions carefully. They hedge exposure. They rebalance over time. They treat Bitcoin like a component of a broader system, not a belief system. That adds stability. And yes, it dampens volatility. That's the trade-off. Less chaos, fewer fireworks, more durability, and whether that excites or disappoints you says more about your expectations than it does about Bitcoin itself. That's the trade-off. Maturity reduces chaos. It also reduces fireworks. And that's why the old crypto playbook feels wrong. It was written for a different market, a thinner one, a younger one, a more reflexive one. Now let's address something practical, because this isn't just theory. Many of you are actively navigating exchanges, custody, and access. If you're testing crypto exchanges, dealing with KYC, or comparing platforms, understand this. Infrastructure matters more in a slower market. Fees matter. Reliability matters. Security matters. When upside isn't instant, friction hurts more. If you're using exchanges through affiliate links or testing platforms for access and compliance, treat them like tools, not lifelines. The goal is exposure, not dependence. Convenience shouldn't replace understanding. And if you want a space to talk through these shifts with people who aren't stuck in cycle hype, I run a free educational Discord. No signals, no promises, just discussion, context, and long-term thinking. It exists for one reason: to help people adapt instead of cope. Now let's go deeper into the part nobody wants to say out loud. Bitcoin's success actually makes returns harder. As it grows, it takes more capital to move. That's not a flaw, that's math. Early gains were explosive because the base was small. Now Bitcoin sits in a different weight class, competing with bonds, equities, and currencies. That means expectations have to adjust. A 10% move at scale is massive. But it doesn't feel massive if you're comparing it to early years. That mismatch creates disappointment, not because the asset failed, but because expectations didn't evolve. This is where many investors quietly burn out. Not in crashes, but in boredom, in waiting for a feeling that no longer comes. If that's you, hear this clearly. You're not wrong for expecting growth. You're wrong if you expect it to look the same. The real opportunity now is understanding the environment better than the narrative crowd, seeing liquidity shifts before they show up in price, recognizing when stress builds under the surface. That requires patience, yes, but there's another layer people rarely talk about, and it's humility. Real humility, the kind where you're willing to sit in a market and say, I don't know yet, without immediately trying to fill that gap with a prediction, a chart, or a date that makes you feel safer. Most losses in crypto don't come from being early or late. They come from forcing certainty where none exists. Because certainty feels productive, it feels like control. You tell yourself a story with a timeline and suddenly the discomfort goes away. But markets don't reward emotional comfort, they reward alignment. And alignment starts with admitting when the map you're using no longer matches the terrain. Here's a tension that almost everyone underestimates, and it's worth sitting with longer than feels comfortable. Bitcoin and fiat can coexist far longer than most people expect. Not forever, not without conflict, but far longer than the narratives suggest. Gold already showed us this. Gold didn't replace fiat. Fiat didn't eliminate gold. They existed together in an uneasy, inefficient, sometimes hostile balance for decades. And it wasn't clean. It wasn't fair. It wasn't symmetrical. But it worked in a messy, compromised way. That's the mistake people make when they hear coexistence. They assume it means equality. It doesn't. Coexistence means competition with friction. It means one system slowly leaning on another, taxing it, regulating it, restricting access at the edges, adding speed bumps where it can't add walls. Friction is powerful because it doesn't need to stop adoption to change behavior. It just needs to slow it, to make it inconvenient. To make it slightly harder than yesterday, that's enough to shape flows over time. So if you're waiting for a clean break, a clear moment where one system collapses and the other takes over overnight, you're going to be waiting a very long time. Those moments are rare, and when they do happen, they usually arrive after years of quiet pressure that most people ignored. But if instead you watch for gradual shifts, you start seeing them everywhere. Not in headlines, not in viral tweets, in policies that seem boring at first glance. Capital controls here, subtle restrictions there, yield suppression that quietly forces savers into risk assets, regulations that don't ban alternatives but make them less convenient, banking rules that don't outlaw exit but slow it down just enough to matter. None of this looks dramatic in isolation. That's the point. Systems don't usually change by announcement. They change by accumulation. Pressure builds quietly. Incentives skew slowly. People adapt without realizing they're adapting. And then one day, behavior has shifted so far that the old assumptions no longer work. That's how systems actually change. Quietly. And then, all at once, everyone acts surprised. Now, I want to pause the narrative here and ground this because this is exactly where misunderstandings become expensive. When people confuse belief with strategy, when conviction turns into entitlement. This might shock you, but I'm not a financial advisor, and nothing in this video is financial advice. Cryptocurrencies are highly volatile, and you could lose all the money you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses, and this video is for entertainment and educational purposes only. Now back to the real issue underneath all of this. What's wrong with crypto narratives isn't optimism. Optimism is fine. Optimism is necessary. The problem is certainty. The idea that markets owe you outcomes because you waited, because you believed, because you held through pain. Markets don't work that way. They don't care how long you waited. They don't care how right you felt. They don't care how many cycles you think you've survived. Markets reward alignment with conditions, period. And right now, conditions reward people who understand liquidity, valuation, and behavior far more than people who can recite dates from memory. The advantage has shifted away from countdowns and toward context. That doesn't mean abandon conviction. It means refine it, sharpen it, stress test it. Conviction without flexibility turns into fragility. Conviction with curiosity turns into durability. So start asking better questions, not when moon, because that question assumes inevitability. Ask, under what stress does capital move? Ask, who is forced to act when conditions tighten? Ask what breaks first when liquidity pulls back, not what's the next catalyst, because catalysts are obvious in hindsight. Ask what's quietly breaking that nobody wants to talk about yet. That's where real edges form. This is how you stay ahead in a mature market, not by predicting exact outcomes, but by understanding the environment better than the stories being sold to you. If it feels like the noise is louder but the signal is weaker, you're not imagining it. As growth slows, narratives get louder to compensate, targets get bolder, timelines get tighter, certainty gets louder because uncertainty doesn't sell. That's always a tell. Real shifts don't need shouting. They don't announce themselves. They show up in policy changes no one reads, in balance sheets no one wants to analyze, in incentives that slowly change behavior without changing headlines. Bitcoin's role in that world is still powerful. Scarcity still matters, neutrality still matters, permissionless systems still matter. But the path forward isn't cinematic anymore. It's longer, it's slower, and it's more contested. That's not a reason to lose interest. It's a reason to grow up as an investor, because the next phase of crypto doesn't belong to people waiting for permission from a cycle chart. It belongs to people who can sit with uncertainty without immediately trying to eliminate it. People who can hold conviction without demanding constant validation. So if you're feeling disoriented right now, that's not failure. That's awareness arriving before consensus. And that's usually uncomfortable before it's useful. Stay curious, stay flexible, and stop letting outdated stories tell you how to feel about price. Subscribe or watch the next video.